Hi, I'm Joe Clark, the managing partner of the Financial Enhancement Group, and thanks for listening to your Retirement Playbook. You know, if you want to be a fiduciary, and we all have one, it's usually the person in the mirror, you yourself. If you want to be your own fiduciary, that is your business, and we wish you nothing but the best. We hope you enjoy this show, and we hope we're providing you good insight, good information that you can use. But if you're looking for a fiduciary, I would encourage you to reach out to the Financial Enhancement Group. That is our business. We're registered investment advisors with the SEC. We take care of more than $600 million for families in 31 states, based right here in central Indiana. You can reach us at yourlifeafterwork.com or call us at 800-928-4001. Again, if you want to be your own fiduciary, that is your business. If you're looking for a fiduciary, that's our business. Call us, 800-928-4001, or go to yourlifeafterwork.com for more information. Good morning and welcome back to Your Retirement Playbook. I'm your host, Joe Clark. Happy to have you along. Hey, we're having a special show today where we're talking about a case. And if you've missed it or if you want to go the whole thing, don't forget you can find Your Retirement Playbook is the whole show. That's our podcast. You can also find that on YouTube, if you will. It's the entire show. And we have 6 other stations to kind of break this down into pieces. The Tax Planning Show, Your Life After Work, the Legacy Planning Show, the Investment Playbook, the Better Giver Show, and the Life Planning Show. You can go to those, but Your Retirement Playbook, the podcast, or this radio show will get you the whole thing. And we're doing it in a case study, really looking at questions that are coming in from a couple that are asking very, very important questions, if you will. They're 55 years old. They have 3 kids, 3 grandkids. They had $1.85 million. Notice I said had. We'll be back to that in a minute. $1.85 million in assets. It was divided. We'll talk about that in a second. They're in good health, not moving. The AGI, the adjusted gross income, was $175,000. Their professions are professional nurse and office administration. We dealt with inflation in the last segment, life expectancy, how you need to forecast how long you need to have your money last. So you can always go back to that to find that under the Your Life After Work segment. Or again, Your Retirement Playbook on the podcast to listen to the whole show. Please take the time to subscribe. We like this information to go out to as many people as we can. And the way the artificial intelligence works, the more subscribers, the more people are actually able to see what's going on. So we would encourage you and certainly appreciate you doing us that favor. So we talked about inflation. Now we're going to talk about volatility. Now, it's an interesting thing. When I taught at Purdue, I used to explain this to the students. And I would ask them the question, is the stock market risky? And without question, every one of them raised their hands except the ones that always figured out that was a loaded question. I didn't ask questions like that where the easy answer was obvious. I defy you, and that's a strong word, I get it. But I defy you to use the word risk in a sentence with a positive outcome. It's just not the way our heads are wired. We have the risk of the electricity going out. You don't ever think about the risk of the electricity being extra powerful today. We have the risk of the market going down. We don't think about the fact that stocks do indeed go up as well as down. Risk is always negative. As a certified financial planner, I was trained to help you understand and mitigate against risk, right? And you could do it through avoidance, transfer, reduction, or retaining, right? There was none of that was optimistic. None of that was on the good side. So when we hear the word risk, we put it in a box of ouch, right? This is a negative thing. Prior to the Great Depression, prior to the fireside chats from FDR, the stock market was never referred to as risky. You will not find it in history books prior to 1934. It was always called speculative. And that's because stocks can go both up and down, right? Now, that's what you're dealing with risk. And risk is the best way to define it in the financial world so you understand our computer models and everything else that people like to use. And I think they're more sales tools, by the way, than they are good things. But that's just my personal opinion. But when you talk about risk, is what is the chance of you getting what you expect And how far away from that expectation can it be? You math people will know we use the word standard deviation to try to figure that out. What is the expectation or the range, if you will, of the expectation? What is the risk that you're going to get something different than what you expect? And with a stock, you should expect the return to be higher or lower, and over an extended period of time to move toward an average. With a fixed income or a bond, historically, you have a lower annual range of expectation of movement, and over a period of time, it will move toward its average or its norm or its expected return. Over a period of time, the fixed income will have a lower amount of volatility and a lower expected rate of return than the equity will per 100 years of economic research and market studies. That doesn't mean that that is applying directly to today. As we talked about with 2022 before, it's one of the first times in recorded history where the best performing asset class at the end of 6 months was actually negative. Almost 10%. It was down 9.62%, as I recall, and it actually happened to be the Lehman Brothers Aggregate Bond Index. So again, the risk doesn't mean that you're going to have a positive return or a negative return. It's different than what you expected. We've seen a lot of things out of the norm in terms of where they are. So how does volatility fit into this? Well, this couple was driven to us. They're 55, and we see a lot of people that are 55 to 64. It made up probably 80% of the family bases that I take care of. For many, many years. The FEG is 25 years old this year. I've been in the industry for over 30 now, over 35 actually. And what happens is the age of people who are now coming to see us aren't just 55 to 64, but we're starting to see some people that are younger, that have saved and accumulated and inherited perhaps, but have saved and accumulated real well. We're also starting to see people that are 70, 75, even upwards of 80 that realize it's time to make that transfer to a registered investment advisor, to a fiduciary, somebody who's obligated to take care of your money as if it were their money and we were in the same situation. So this is very, very typical. They're 55. The key thing here is they had 1.85 million at the beginning of the year. It's now 1.65 million. And the one spouse looked at the other spouse and says, "Darling, don't you think it's time we consider having a conversation with somebody?" That provoked the call, that had the meeting, and voila, here we are. Now, they had 50% of their money in the 401k plans that was tax deferred, 30% that was in a Roth. They'd done a really, really good job paying attention to the tax conversion rules, contribution rules. And keep in mind, and I've talked about this before, there are 5 critical elements, and it's easy to be really, really good at one and miss out on 2 or 3 of the others and still jeopardize your financial plan. This is not what made me successful. The FEG was built on the backbones of me focusing on my A-plus ability and hiring other people to focus on their A-plus abilities and to work around our C areas. I will never be good at minutia. I will never have neat handwriting. And God bless Grammarly and spell checkers, right? I'm all about having those kind of things where I've got other people who could edit in their sleep, right? So we all have different skill sets that are here. This tax ramifications, 50 in the Roth, 30 or in the 401k, tax deferred, 30 in the Roths, 20% that's taxable, exposed to the IRS every year, has 0 to do with volatility. Or does it? And the answer is it does. See, volatility by itself is the market going up and down. It's not a good thing. It's not a bad thing. You may wish it would go away, but you certainly don't wish it away when the market's having a 25% year, right? Volatility is merely up and down. Its challenge is when you need money and the market happens to be down. That's a liquidity issue, not a volatility issue. It is a poor planning situation as opposed to paying attention to what is happening and the normal nuances of what's going on inside of the market. But volatility does come into play in this taxable distribution. It is important to have that tax diversification, to not have all of your eggs in one basket. It never should be all stocks, all bonds, cash. I think any of you watching this show get that. but it should not all be tax deferred, tax free, or after tax. Now, some of us are in a world where it's always going to be a much larger percentage in one of those three areas than the other. The sale of a business or farm ground, something of that nature, or you only had access to a 401k while you worked at Lilly or Caterpillar or General Motors or wherever it happened to be. I get that. But if you can build it, this is a pretty good formula. Ideally, when I go to separate from the workforce, I would have 1/3, 1/3, 1/3. 1/3 tax deferred, 1/3 tax free, 1/3 taxable, because I don't know what the IRS is going to do along the years of my financial journey in terms of changing the rules. The one thing I know for sure is there will be changes. Now, what I do know is I look at this, and as I study this, I can make changes in my 401k from stocks to bonds to cash without any tax implication at all. Anything that happens before the money leaves that container has nothing to do with taxes. So as volatility increases, I can decrease my exposure to risk. Remember, I hate that word, but I can decrease my exposure to uncertain outcomes. Should you ever be all stocks, all bonds, or all cash? Absolutely not. Absolutely not. Should you have a mechanism, a discipline? We have the risk barometer, our proprietary process that we use. But should you have a system, a discipline that removes emotion, provides discipline that says we're going to increase or decrease our risk exposure based on these mathematical conditions that are not subject to emotion or opinion? My answer to that would be yes, and that's why you hire a fiduciary, by the way. They have to stick to that discipline where you are going to have emotion come into your individual things. Inside of the Roth, there's no tax implication as long as it happens inside of the Roth. In the taxable side, we look for periods of time of negative market volatility because it gives us the opportunity to go in and do some things from a tax planning standpoint that may not help us this year, but will certainly help us on our financial journey. That volatility is critical. Now, I'm going to run out of time here, but there's one other important part of volatility up here, and it was the AGI. Remember, the family made $175,000 a year, but $20,000 of that was overtime. That's what we call income variability. And when you're doing tax planning, and remember, that should happen every year, not the tax reporting. That's what you tell the IRS. That's how much you pay in taxes. But when we're doing the tax planning, that's what we have to do by the end of the year. We're looking for income variability plus or minus. If that overtime was gone one year, we may want to look at doing a Roth conversion. If it was extra this year, we may want to stay away from the Roth conversion. Many things to take into consideration. We've covered the case. We've talked about inflation. We've talked about volatility. Legacy is next. Go to Your Retirement Playbook. Subscribe to the podcast. Get the whole show. But don't forget our YouTube channels. YourLifeAfterWork.com. We'll be right back.